Uh, Weekly top 10. We're doing the session. We're doing the session on YouTube itself. I was sharing the link with Zoom participants. You're already on the right link, so you don't need a link. Yes, the session gets continued on YouTube. For the whole session today comes on YouTube. So if you're not a FinTree participant but you want to participate in the session, you're welcome to do it. The session will remain on YouTube as well. Of course, we'll do some editing, but it will remain there. Okay, guys, so I'm going to make an assumption that all of you have moved. Yeah, can you please close the door? Thank you very much. By the way, there is something I wanted to discuss. Just like a warm up before we get started with the main session, just a little bit of warm up. People are still coming in. People need to know that they're supposed to come on YouTube. So typically, how does your money compound in the equity markets? Okay, how does your money grow in equity markets? So wait a minute, let me connect my tablet properly. So we have this mathematical formula, right? The formula is whatever is the future value that I have. Okay, whatever is the future value that I have, that is equal to whatever is the amount that I invest. So this is called the present value, which is called the amount invested. Okay, this is what I get when I retire. Okay, so this is my this is my, let's say, retirement corpus. Okay, this is my money that I will have in future. So retirement corpus, right? So present value multiplied with 1 plus r raised to n. Really easy rule. Now what is this r? This r is the rate at which money grows. Okay, rate at which money grows. And this n is the time period. Okay, so in my experience, with whatever investors with whom I've spoken over a period of time, what mistake a lot of people do, including me, I think I've also been guilty of doing this, is we kind of have too much of overemphasis, like too much of emphasis on this number R, right? So everyone focuses about this R, but the real money in the market is made is if you also have a good enough N, right? If you just have R, but if you do not have N, you do not make money. Now, what do I mean by that, right? So we always think that, which is that hot stock that I should buy, right? So that I would, that hot stock which will give me, let's say 25% return, right? I'll be very happy if I get 25% return. But if you get 25% return for 1 year, it's not going to cut it out. What you want is your portfolio to compound for a long period of time. And how to do that, how to give that time factor to your, to your equity investments is to invest early, right? And then people will say, Utkarsh, how can we invest early? I'm 35-year-old, I'm 40-year-old, I'm 50-year-old, I'm 20-year-old, whatever. So then I tell them, invest today, right? Uh, 5 years from now, you'd feel, uh, man, I missed the opportunity. I should have invested in 2020. So the earlier you invest, the more time you get to compound your money, the better money you make in the markets in the long run. All right. So in equity, in the world of equity, the time period for which you invest is extremely important. So you have to invest for a sufficiently long period of time so that you get the full benefit of that compounding component. And somehow, when I say this, people don't get confused. So I asked them this story. I asked them that, do you know any relative of yours, or do you have any friend of yours who's made a lot of money on a real estate, right? Especially on the house that they live in, right? And I'm sure all of us have heard of someone who bought a house for 50 लाख में खरीदा, 2 करोड़ हो गया, 10 लाख में खरीदा, 1 करोड़ हो गया. You bought it for, you know, 5 million, it became 20 million, it became 10 million. You keep on rupees, I'm saying, Indian rupees. You keep on hearing stories like that, right? And I'm sure you have your relatives who's probably made that type of money. Maybe you have made money. So ask yourself, why did you make money on your house, right? And most probably your answer would be that I made money on the house because I stayed invested in that property for 10, 15, 20 years. Correct? The thing with house is it is a low it is a lower compounding asset. It is a low rate compounding asset. What does it mean is a residential property doesn't compound at 20, 25% unless and until something crazy happens in the area you live in. Residential properties in India, depending on geography, would compound maybe at 5, 6%. If you're lucky, ignore of course the rental yield. So if an asset is compounding at such a low rate, maybe 7, 8%, maybe 10%, depending on the area you live in, then how come people make so much of money on their houses, right? The reason is that house is an illiquid asset, and illiquid means that whenever whenever you're if you want to sell the house, it's not easy to sell. If you want to buy the house, it's not easy to buy, right? There's a level of discomfort when buying and selling the house. It's not easy to do that. So every time the values are falling, every time the values are going down, it's not that you get up in the morning and you say, oh, house prices are falling by 20%, let me sell the house today. Or every time values are going up, you don't come and say, okay, let me buy more of these houses today. It doesn't work that way, right? Once you buy a house, you decide that I'm going to stay with this for 15, 20 years, probably I'll never sell it. That means your mindset with the house is that you're going to keep invested in that house for 15, 20 years, and that is what results into massive accumulation of wealth over a period of time. So the key that I have learned in equity markets is that you have to invest early, and then you have to stay invested no matter what happens in the market, right? There will be more COVIDs in the future, probably. And this is my thesis. I'm not asking you to do that. This is how I think about investing, right? There might be more COVIDs in the future. There might be, some war in the future. Markets will correct by 15%, 20%. People on the television will tell us how scared they are and how bad the situation is. But if you can stay invested throughout all this noise, equities have made money for the investors in the long run. So the trick is that, fine, you do focus on R. If you can buy assets which compound at a good rate, good for you. You're an analyst, you can compound your asset at, you're a smart guy, you know how to buy the right set of stocks, you can compound your assets at 12, 15, 18, 20%. Phenomenal. But at the same time, stay invested for 10, 15, 20 years, and let the magic happens, right? And then you'd suddenly realize that even a small amount that you invested in 15, 20 years becomes a massive investment amount, right? So that's just my 2 cents on investment. Again, not an advice, not any sort of recommendation. It's a class. I'm trying to tell you what I know, and you're listening to it. If that makes sense to you, you decide what to do with it. But I'm not advising you in any way here. Okay, just protecting myself from the regulatory guidelines. All right. So coming back to the world of equity valuation. Now, what we have done a little bit is we've done relative valuation. We've worked on the price earning multiple piece of it, correct? So we know a little bit about it. Now, we would also want to know a little bit more we would also want to know a little bit more about one more vertical here, or one more multiple here, which is called the EV by EBITDA multiple. Okay, and this is one of my most favorite valuation metrics to use. Okay, I kind of love this valuation metric in practice, and it's a very solid concept, a beautiful concept. And the good thing with EV by EBITDA is it works on almost any type of companies. No matter what company you're dealing with, there's a good chance you would be allowed to use or would be able to use a EV by EBITDA multiple there. So how does a EV by EBITDA multiple work? Okay, so it has two pieces. One is the enterprise value. Second, the EBITDA value. You have to divide the two, you get the multiple. But what does enterprise value really mean? So we have a formula, right? I'll show you the formula, but then later on we'll kind of delete the formula and try and learn this with logic. This enterprise value is calculated as market value of equity plus plus market value of the debt plus market value of if companies issued any preference shares or preferred stock. So plus market value of the preferred stock minus the the cash and the short term investment that the company is sitting on. Okay, so cash and other investments that the company is sitting on. So this is the definition of the enterprise value, which is market value of equity plus market value of debt plus market value of preference shares, cash and short term investments. And what is EBITDA? EBITDA is your earning before interest, tax, depreciation, amortization. You would find this number easily on any of the websites. Typically calculated as sales minus the manufacturing cost minus the other business operating cost, other operating business cost, except depreciation. You don't deduct depreciation, you get EBITDA. Then after EBITDA, you deduct depreciation. Okay. Now, what is the logic behind this? So fine, we know the formula, but how do we make use of it? What's the logic of this number? So let's try and work a little bit on logic now. And this part gets very interesting. So I want all of you to be super alert now. I'm sure you're going to really love this enterprise value metric. So let's say we have a nice business here. Okay. And I'm going to break this business into two parts like a balance sheet. On the left hand side, we're going to have first type of investors in the business, the equity investors, right? The owners of the business. But we also have the other type of people who've put in money into the business, the bondholders. Okay. And equity guys have put in, maybe 5,000 in the business. So that's the valuation. That's kind of 5,000 here. The bond guys have put in 2,000 here. Now, what company has done is it has taken that money and it has invested into property, plant, and equipment. Okay, like the core business of the company, the factory and the machinery and the land there, all the core investment. So they've put in, let's say about 3,000 here. Okay, and then what company has also done is they have also invested into inventory. They have done a little bit of accounts receivable, that kind of comes in the normal course of business. So that is about 2,000. And then companies just sitting on excess cash. Okay, that cash that probably they don't want to use right now. So they've just invested into temporary liquid assets, and that cash is of 2,000. And that is how we have a total of 7,000 of the balance sheet. Now listen to me carefully, okay? And if you truly listen to me, you'd understand the intuition of the formula. And very few, I've seen even the analysts, right, who have worked in the industry for a few years, that don't really get what the intuition of the formula is. Okay, so it's a really beautifully designed formula. Just understand what this formula means. What we want to do now is we look at the assets of the company and we tell them that can the company do its business, the core business, maybe it's a manufacturing company. So can the company do its core manufacturing business even if it doesn't have the cash? Answer is yes, right? Maybe it needs a little bit of cash for day-to-day functioning, but the core business is here, correct? The core business of the company is here. So what we want to do is we want to figure out what is, and this is where I'm kind of hitting the core point. So I want each one of you to be super alert here. What is the value of of core business, core business of the company? But what definition of value? Is it like the true value? No. But what is the value that market thinks? Market thinks how valuable it is. We are not looking at an intrinsic valuation. We're not doing valuation ourselves. We just want to know what the people on the street think, like what the equity guys think, what the bond guys think, right? How much do these people think? How much is the market value of these assets? Now, how do you get that, right? It's so difficult to find out how much people think. I mean, one thing you can do is you can just call up people, ask them, what do you think is the worth of this business? But instead of just calling and asking them, why not use a slightly more logical way? Okay. So what is a logical way? You go and find out how much is the market value of this equity. 5,000 is the book value, isn't it? It's the valuation that we see in the books of account. But maybe in the market, equity is trading at a higher valuation. We call that as a market capitalization. So maybe we have a market capitalization here of, let's say, 20,000 rupees. Is it possible? Is it possible that I'll have a 5,000 book value and 20,000 market value? Do you think that works? Yes, of course. Why not? It happens all the time. The market values are 20, 30, 40 times of their book value, right? So the market values could be substantially higher than equity values in the book. So people in the market are willing to pay 20,000 to buy these equity shares. Now, typically, the market value of the bonds will not vary so significantly. So the market value of the bond would pretty much be closer to that 2000. It will not be varying significantly. So I'm going to keep this as 2000 itself. Okay. So what does it mean? If these people on the left hand side who are contributing money to buy the business, or contributing or funding to the business, the total valuation that these guys are assigning on the balance sheet on the left hand side is 20 plus 2, 22. All right. Now, would you agree that if the left hand side is 22, the right hand side should also be 22 based on the market valuation? Yes. If the left hand side is 22, the right hand side should also be 22. So now we've established that this is 22,000. And if this is 22,000, right? And then this is 2,000. So by that logic, for my equation to work, this blue circle should be how much? This blue circle should be, this should be 20,000 here, correct? And that 20,000, my friends, is called the enterprise value. That 20,000 is the true enterprise value of the business. So how do you want to think of enterprise value? Is the value of the core business of the firm, the factory, the machinery, the employees, the operational functionality, and that is the value which is assigned to this business by the participants in the market. Now, let's reverse engineer this a little bit. Okay, so now same balance sheet, but let's see how we're going to think of it. So I'm writing the same stuff. PP is 3,000, and the inventory and other stuff is 2,000. Cash is 2,000. We have equity guy and we have debt guy. These are the book values. They don't mean much. Okay. Now, if you already knew, if you knew that this is worth 20, okay, if you knew that this is worth 20, cash is worth 2, so you will say that See, the business is worth 20, the cash is worth 2. So I am willing to pay 22,000 for this business. But there is a debt of 2,000. So therefore equity is worth 20,000. Is that a logical way to look at things if I reverse engineer this? If I know that this business is worth 20,000, but not only that, they have a cash of 2, so the total value of the this entire organization is 22, which means, and they have a debt of 2, so which means the equity should be worth, uh, if they have a debt of 2, the equity should be worth 20, right? Can I do that kind of a reasoning here? Yes. So what we're really doing here is we don't know this 20. Okay, we want to find out that 20, but we don't know that 20. So we reverse engineer it. So the way we reverse engineer, we go and look at what is the market cap. So market cap is 20,000. Now, why are they paying 20,000? Because they feel that business is worth it, right? How much is the bond? 2,000. So that means these guys are probably valuing the entire asset, all the asset side at the market rate of 22. But on the asset side, I have that extra cash sitting in, which I probably don't use for business. That's not my core business. I'm just sitting on it. So my core business valuation must have been 20,000 to make the equation work. And that is what you really mean by the enterprise value. The value which is assigned by the participants of the market on the core business of the firm, and that is how we get the formula. And now I'll write the formula. Now maybe the formula will make a little more sense for you. Market value of equity here 20,000 plus market value of debt, so 20 plus 2, 22,000 minus these cash. So when I say minus cash and other investments, I get the true enterprise value of the firm. That is the derivation or intuition behind the formula. Now, can you please give me a yes or no if you understood the formula or not? And in case if you have any questions, feel free to ask them now. Okay, awesome, very nice. So this is the enterprise value. Now, what is the beauty of this method? What is the beauty of this method, right? This is an, by the way, again, all the people who are on Zoom, my request to you is if you can move yourself to YouTube and try and not put comments on the chat box on the Zoom because I'm not monitoring it. Go to YouTube and just go to YouTube and put all your comments there. Okay. So let's say we have two companies. Okay, company A and company B. Now, what company A has is company A has a factory. So this is the with my phenomenal drawing skills. This is the factory. Okay, and they have little bit of extra cash sitting with them. Now we have company B. Okay. Now company B also has exactly the same factory. They probably have exactly the same level of cash. Okay. Now company A is an all equity company. It does not have a debt. So let's say equity is 1,000, factory is 900, and cash is 100. Factory is 900, cash is 100. But whereas company B has a very low level of equity and it has most of the level of debt. Now what we want to do is we want to see that how these companies are performing on a year-on-year basis. Okay, we want to understand the performance of this company. Okay, so let me now do a profit and loss account for both the companies. Now when I do a profit and loss account, and it gets very interesting, you're going to enjoy this. This company did a sales of 1,000. This company did a sales of 1,000. This company did a sales of, uh, let us say maybe This company did a sales of, let's say, 1000. Okay. Then this company had manufacturing and all the other business cost before depreciation. So it had a manufacturing cost of 600. This company had a manufacturing cost of 500. So when you manufacturing and other operating cost, okay, so when you do manufacturing plus other operating cost, the number that you get is EBITDA, earning before interest, tax, depreciation, amortization. This is 400, this is 500. Now, depreciation is 100 for both of them. So they charge a depreciation of 100. Okay, so we get the EBITDA number. Then we charge depreciation of 400, 100 each side. And then we get something called as a EBIT. So EBIT of 300 and EBIT of 400. Now we have to pay interest on, whatever loan we've taken. Can you please help me figure out what should be the level of interest on company A? The interest payment for company A, the interest payment for company A is going to be 0. Why? Because there is no debt. So we get earning before taxes of 300, and let's assume you're living in a tax-free world. So no taxes, and I'm just going to do earning after taxes, just to kind of, because I'm short of space here. Okay, tax doesn't matter in this calculation, at least so far. But company B will have to pay interest. So let's say interest, interest is expensive, maybe in the market they're living in. So maybe an interest of 160. Okay, interest of 160. And then we will directly have the net profit. I'm ignoring the taxes, and we have profit of 240 here. Now, what I want you to do is, I want you to tell me, let me give you a market capitalization of both the companies. In fact, forget, let's assume that this is the same as market cap. Okay, so market cap here is 1000, just for simplicity, and market cap here is 200. Now you tell me, if you had to select a stock, guys, please, everyone, each one of you, don't do anything else, no random YouTube chats, everyone. This is very important. If you learn this, you're going to have that aha moment. I want you to have that moment with you. I want you to have that level of excitement you have when you get this concept. So focus, just minute or two, that's it. Market cap of equal to book value. Now what we want to do is, we want to calculate the PE ratio of firm A and firm B. Okay, so firm A and firm B, we want to calculate a price to earning ratio. Now to price to earning ratio, what we need is, we need market price, correct? We need market price, and we need the EPS. So for simplicity, what we're going to assume is, we're going to assume the company is issued only one share. Okay, just so that our calculations are easier. Okay, just one share. So then what would be the market price of company A's share? The market price of company A's share would be, market price of company's A share would be 1000. Okay, market price of company A's share is going to be 1000. Market price of company B's share is going to be 200. Then uh, then the profit of company A, which is same as EPS, because now we have just one share, right? So profit of company A is 300, and profit of company B is 240. Now you calculate the P ratio, please. Please help me with this. What is the P ratio of A and what is the P ratio of B? And tell me, which company are you going to select? Which company do you think is more efficient? Which company do you think is doing the business smartly? Uh, which company would you like to be a part of your portfolio? Are you going to go for company A or are you going to go for company B? They have identical plans. They have same plans. They have, same stuff everywhere. Now, based on this, you have to figure out what company makes more sense to you, company A or company B, and how much is the difference between the two. Okay. So if I calculate a P ratio, this will turn out to be 3.33 market cap divided by EPS. And if I calculate the P ratio, and where is my calculator here? Okay, guys, I'm going to need my calculator. Give me a minute. Oh, it's just here. Yeah. So for company B, I'm going to calculate my P ratio of I'm going to calculate my P ratio of 200 divided by 240. I'm getting a P ratio of 0.833. Correct. Clearly that P ratio of 0.83833 to me looks a little more attractive. Are we together with this so far? That there is a large difference in the P ratios. So therefore, it looks like B is so far more attractive to me. Now let's play around. Let's play around this a little more. Okay, just for the fun of it. Now let me do it this way. Let's increase the cost of debt. Okay, let's increase the cost of debt to 30%. Okay, let's make debt more expensive. Okay, so you have to pay all the more interest to get the debt now. So if I make this cost at 30%, now we will have to pay interest of 240. Correct. Then I would be left with profit of 160. What I've done, I've changed the interest rate from 20 to 30%. I changed the interest rate from 20 to 30%, and now we have to pay interest of 240 on 800. So my profit becomes 160. Gorish, the rule is lower the P ratio, better it is. So now my profitability is changed, and now my profitability has become 160. Let's calculate the P ratio, and we'll do this iteration a few times. So 200 divided by 160. Now we're getting a P ratio of 1.25. Now tell me which P ratio is lower and which company do you want to select now? Are you going to select A or are you going to select B? Are you going to select A or you're going to select B? Are you going to select A or B depending on which P ratio is lower? What's your selection? Because generally lower P ratios means you're getting you're getting that stock at more attractive valuation. A lower P ratio means it's cheaper. Lower P ratio means sasta mil raha hai. Right? Now we're not getting into the risk of debt for the timing. I'm just kind of keeping a pin on it. Mustafa, I'm just putting a pin on the risk coming in from the debt. Just trying to see on a P basis what looks more attractive. Okay, so B looks even now B looks very attractive, right? Now let's play a little more, guys. Okay, let's play a little more and let us now increase the. Now I have a very little bandwidth to play around. 832. Let us increase this to. Let us increase this to 45 percentage. Okay, let us increase the interest cost to 45 percentage. Okay, and let's have some more fun with it. So 800 into 45 percentage. Now I have interest cost. Now I have interest cost. Come on, help me with the number. Is 360. So now I have an interest cost of 360. Now I have a net profit of 40, ignoring the tax part or assuming tax is 0. So now I have a net profit of 40 because my interest cost went up, and let's have 40 here. And now tell me, what is your P ratio? What is your P ratio? If net profit is 40, what is your P ratio? Correct. Your P ratio now is going to be 5. And now tell me which company would you like to select? Would you like to select A or would you like to select B? Based on the P ratio. If you had to select between one of the two companies, are you going to select A or are you going to select B now? What is the selection in your portfolio? Which stock do you think goes in your portfolio? Correct. Now many of you are going for A, right? But what I want you to do is, what I want you to do now is, A is a lower P ratio. It looks attractive. I agree. But I want you to look at the two income statements carefully. Okay. I want you to observe the two income statements and tell me that if the factories are exactly same, if the assets side are exactly same, if by observing numbers, do you think one company is smarter than another here? Their assets are exactly same, identical factories, right? Their businesses is exactly same. There is no difference whatsoever. There is no difference whatsoever as far as the business is concerned. Do you think one company is smarter than another here? Just look at the business and look at the profit and loss account and tell me if one company is smarter than another here. Come on, which company do you think is smarter, guys? Do you think A is a smarter company, a more efficient operator, or do you think B is a smarter company from a manufacturing operations perspective? Do you think it's A or do you think it's B? It looks like, guys, B is a smarter company because it is able to manufacture the product at a level of 500 and keep 500 of profit for itself, right? So focus on the EBITDA number now. Whereas A looks like relatively less efficient, right? A looks like relatively less efficient because it takes 500. If they have the same factories, if they have the same assets, then clearly, just using these assets, when I'm just using these assets, I know that this B is a smarter operator because it was able to manufacture the same level of products at a lower cost. So what is this 900 here? What is this 900 here? This 900 is the enterprise value of the business, right? So what we're saying is, we're saying enterprise value of A and B is same. Their equities might be different. A and B might have different values of equity, right? They have an equity of 1,000, they have equity of 200. Doesn't matter. But the enterprise value, how do you calculate enterprise value? Enterprise value is the value of the core operating business. So when I look at enterprise value of A, 1,000 minus 100, 900, 200 plus 800, 1,000 minus 100, 900, the value of the core business. So enterprise value of both the businesses is 900. So when I'm taking enterprise value, it will be wrong on my part if I compare the net profit number with, in conjunction with enterprise value. Why? Because it doesn't matter how I got that enterprise value. What matters is, in reality, I have these two factories, they're exactly same. And if I want to see what kind of returns I'm able to extract out of those factory, the comparison should happen at EBITDA level, not at the net profit level, because net profit is affected by how you raise that money. We're not worried about how I raise that money. We're worried about how efficient we are with the size of the business that we have. So how I raise money is going to affect my net profit because interest kicks in here. But without worrying about how that enterprise value is derived, how that money was raised, If I just look at this is the size of factory, how much value I'm able to derive out of it, that valuation is kind of coming out of at the EBITDA level, correct? So the correct metric for me to compare is the EBITDA level metric, EBITDA, without considering the depreciation or the interest number. So when I do the EBITDA level comparison, here we have a EBITDA of 400 and here we have a EBITDA of 500. And then I calculate my EV by EBITDA multiple. And of course, lower the multiple, better it is for us. So 900 by 400, this should be what, 2.25. Please correct if I go wrong. And how much should this be? This looks like it would be 1.8. Is that correct? Yeah, it looks like. Please correct if I've made a mistake. Now, on a P basis, you might have, you would have selected A, but on a EV by EBITDA basis, you would probably select B, right? Because that is the right set of comparison. If you're going to compare enterprise value, if you're going to compare the enterprise value, then see enterprise value with EBITDA rather than looking at net profit. It doesn't matter how we got the assets, but now that we have identical assets, then we should ideally would have made identical profits, right? Based on these assets. But clearly we made more profits because it is a more efficient operator. And that is the reason why EV by EBITDA is such a beautiful multiple. At times, price to earning could be misleading, especially if you're comparing one company with low debt, one company with high debt. So if you compare a low debt company with a high debt company, price earning ratio will almost always give you a wrong answer. P ratio will almost always make a mistake. So then the right way to do it is to use this EV by EBITDA multiple, which kind of allows you to compare apples to apples, and then you can take a better decision out of it. Now, this is a slightly tricky concept, so I understand if you're finding it a little difficult. Here's what I'll recommend you to do. If you've understood this, just give me a, give me understood on the chat box. And if you have any questions, then try and type in those questions on the box so that I'll, answer them. And maybe we'll try and practice this EV by EBITDA on few listed companies so that you can also work on the skills. In general, Suganya, any multiple, price to earning, price to sales, price to cash flow, EV by EBITDA, any multiple, lower the better. That means you're getting the valuation cheaper. Everything else same. So Dilip, the intuition is enterprise value is, how do you want to think of this? Okay. Uh, so let us say, uh, let us say enterprise value is the value assigned to the core business of the company. So you think of, I'll show you some examples. Okay. So let's say you think of maybe continuing with the company we were studying, before the break. If I take some of the examples, let us say you think of some FMCG company. Okay. Let us say a company like maybe Nestle. Now, Nestle has a core business and then maybe they have, a little bit of extra cash, and then they're raising money through equity. They're raising money they're not doing debt, but let's say they have equity, they have debt. We don't care about how money was raised. What we care about is what is the value assigned by the market to the core business of Nestle, the manufacturing plant, or the outsourcing that they have, the whole set of operations. And on that core set of business, how much money are they able to generate on the EBITDA level? Why are we not taking net profit? Because net profits are affected by the interest cost. Okay, so let's apply this on a few companies. You'd learn this better. You'd enjoy this better. So let me just clean up my screen and take you to the screener. We'll try and see if we can apply this on a few companies. Now here we can, apply this on a, even a little more complicated business. Okay. ITC now, the Indian tobacco company, which is a tobacco company, but also 1,000 other things, right? They probably want to do everything, like if they see a business, the guys at the top feel like, maybe we should do that business. Anyway, so this is ITC Limited, and what we want to do now is we want to calculate their enterprise value. So we'll do our exercise in two parts. First, we will calculate the enterprise value. I'm going to create some space on my screen so that I can write down my calculations on the screen itself rather than moving between the screens. So first we will calculate the enterprise value, then we will calculate their EBITDA, then we will calculate their EBITDA, then we will calculate their EV by EBITDA, and we'll probably compare with some other companies. Okay, so this is for ITC. This is for ITC enterprise value. How do we calculate enterprise value? Market value of equity plus market value of debt. Now, generally, market value of debt is closer to book value of debt itself because debt values do not fluctuate so much. Generally, I'm saying generally. So market value of debt plus market value of preferred stock. If they have issued any preferred stock, we have very few companies listed in India which have issued preferred stock, minus if they're sitting on any cash and other investments. So if there are any cash or other investments, then we probably want to kind of reduce that from our enterprise value calculations. Okay, that is your formula. Market value of equity, yes, sir. We do have the market capitalization of the company, and that's a massively large number. We have 266,158. So that's your market value of equity. Plus, do we have market value of debt? Now we can look at on the balance sheet if they have any debt. So let's go to the balance sheet and let's see if we can spot some debt there. Yes, so we have some borrowings here. What is the value of borrowing? We have 291. And do we have any short-term borrowings here? No. Now, these borrowings that you see here, right? They're actually because of the new accounting standard. This new accounting standard, if you have taken some asset on rent, they kind of force you to show that asset as if you own it. That it's very complicated. It's called accounting for leases. So my guess is it's actually that, but just to kind of keep things simple and not overcomplicate it here, because it's not accounting class, I'm going to do just 291 here. Okay, which is the value of borrowing that I see on the balance sheet. Ideally, I mean, if I were doing it for myself, I wouldn't have added this. I would have just gone and see how that liability is coming. But just to keep things nice and easy for us, 291. Do they have any preferred stock? No. Minus, are they sitting on large value of cash and other investments? Of course, yes. Right. ITC sits on insane amount of cash and investments. So what investments they have? So clearly one number that I can see here, is 24,271. So 24,271 is made, but they would probably also have, some excess cash here, and that cash is about 3833. Now 287,771 and also 3833. Okay. Now, again, we can go a little more granular and we can, debate about whether this cash should be deducted, not deducted. There are all these, ifs and buts, but I'm kind of playing plain vanilla and simple here. So let's do the math. Give me what enterprise value is. 266,158 plus 291 minus 24,271 minus 3833. We're looking at 345. Thank you very much, Suganya. 238, 345. That is your enterprise value. Now, what we need next is the EBITDA number. So let's go and calculate the EBITDA number for the company. Now, EBITDA is ready-made. So let's Let's go to profit and loss account on screener and let's see if we can get the EBITDA number. So EBITDA number, again, you can decide to do a little bit of normalization there. Okay, let's see what we have in expenses. Material, manufacturing, employee, and other cost. So my understanding is screener's operating profit is actually EBITDA. The operating profit that screener shows, that is not EBIT because they deduct the depreciation later on. So that is actually the EBITDA number. So EBITDA number is 16,000, again affected by COVID, right? 16,000 is affected. So you can debate and you can say, Utkarsh, don't take 16,000, take 19,000, because had there been no COVID, they would have made at least 19,000, correct? So depending on what you tell me, if you tell me 19,000, I'll take that. If you tell me 16,000, I think 19,000 is the right way to go. So just let me know what you think should be the number taken. Uh, should I go with 19,000 or should I go with 16,000? Okay, so let's go with, since most of you feel that's the number we should go with, I think that's the more logical way to do it. So EBITDA number is 19,344. And there you go. We do have our EV by EBITDA multiple ready. And what is that EV by EBITDA multiple? It would be 238,345 divided by 19344. And can you tell me how much is that multiple? Can you please help me with the calculation here? 238,345. 238,345 divided by 19344. So we're looking at a multiple of 12.32. 12.32. So that is the EV by EBITDA multiple. EV by EBITDA multiple of and what do we do with this number? How do we use it? What is to be done? So this number is to be compared. This number we should compare with the competitors of ITC. This number we should be comparing. Sorry, I drank. I think by mistake I drank the leftover coffee of last night, or I don't know what this is. Okay. Now, this number we should compare with some of the competitors of ITC. Now, the problem is because ITC does so many different businesses, it's not easy to find one competitor, but I'm still going to go ahead and choose one. Since almost 80% of ITC's profits actually come from tobacco business, I'm going to choose a competitor from tobacco industry called VST Industries. Okay, so VST Industries is another tobacco company. They call the Wazir Sultan Tobacco industry. They make low-cost cigarettes in India, the smaller size cigarettes, and we're going to kind of calculate the enterprise value and EBITDA for VST and do a similar analysis here. Okay, so let's do that quickly. Just a minute. So let's do a similar type of analysis for VST now. So first we will calculate the enterprise value, market value of equity plus market value of debt plus market value of preferred stock minus cash minus short-term investments. So market value of equity is 6,000. So it's a really, really small company, 6,112. Market value of debt, I don't think they have any debt, but let's go and check. So we'll go to their balance sheet and we'll see if we have any debt there. So we are on the balance sheet and there is no debt, right? So market value of debt is 0. So market value of debt is 0. Preferred stock, 0. Are they sitting on cash? Yes. Just like other tobacco companies, they generate too much of cash, right? Massive amount of cash. It's a cash-rich business. Plenty of cash that comes in. So how much is the cash do they have? So they have 739 here. So I'm just picking up a little bit of speed now with this. So we have 739 as cash. 739 is investment in fact, and we have a cash value for another 25. That's negligible, but I'll still deduct that minus 25. So now let us see what do we have. So we have 6112 plus no minus 739 minus 25, and then we have an enterprise value of 5348. Now let us calculate the EBITDA number. The EBITDA number, we'll find that EBITDA number in the profit and loss account. So in the profit and loss account, March 2020, operating profit is 415. And ironically, the TTM is also 415. So apparently, since this is a pure cigarette company, it looks like the smokers don't care about COVID, no COVID. They somehow managed to get their, they did jugaad and they managed to get their product. It's crazy. COVID doesn't affect cigarette business, it seems, right? So good. So 415 is the number we take. Makes our life easier. No normalization required. Let's do EV by EBITDA multiple. EV by EBITDA multiple. It's a lot of fun. So 5348 divided by 415. Come on, help me with this number. How much is this? It's about 12.88. 12.88. Correct? And now finally we compare the ITC. We compare the ITC and these together in one screen. So ITC and VST industry, EV by EBITDA multiple. Here we got 12.88, and here we got 12.32. So we almost there, not significant difference. We will also look at P ratio just for the fun of it. But now since I want to save time, I'm going to take a ready-made P ratio. So for VST, a P ratio is 20. VST, a P ratio is 20, and for ITC, and since the companies are debt free, I don't think there would be massive differences. P ratio is 18.9. So if I had to select the lower of the EV by EBITDA, marginally lower. If I had to select the lower of the P ratio, marginally lower, but they're kind of almost equivalent. So we would not say they're either overvalued or undervalued. We'll say they're there. They're somewhere there. Correct. So that's how we would think of these two. Sorry, I was saying something happened. I don't know what. Maybe internet or maybe some technical glitch. But can you confirm if it's okay now? Can you confirm if it's all right now? Okay, good. Thank you, and I appreciate your patience. Okay then, so I hope this whole EV EBITDA business is making sense to you. Gaurish, you probably want to see some of my level 0 videos to make sense of it. To understand what preference shares are, it's covered in the level 0 class. You can go and see them. But anyway, so now let me. Do you want to see what kind of questions will be asked on the exam, especially CFA level 1? Let's do a little bit of exam preparation now. Let me show you what can be asked on the exam. Okay, so So I'll have to probably enable my screen there. Okay. So let's prepare for the exams now, at least for on the EV by EBITDA front. So they'll give you a question like this. Cheryl, I will answer your question. Just keep it on hold. Let me just get this question done first. So let's say we have a company A, which has a balance sheet like this. It has a little bit of equity. It has debt. Let's say debt is 5,000. Uh, equity is 3,000. And then they have property, plant, and equipment. They have inventory, all the business assets of 6,000. And then they have a cash of 2,000. EBITDA of this business is 2,000. Number of shares issued is 10. Okay, this company is issued 10 shares. Now in this industry, in the peer group, the average EV by EBITDA multiple, EBITDA multiple in this industry is, let's say, 8. Now, based on this information, what you'll have to do is you'll have to do equity value per share or value per share for form A. Okay, so value per share for A is what you'd have to calculate using the information presented here on the balance sheet. All right, it will take you probably 30 seconds. You know the formula, you'll have to improvise a little bit. Okay, so take your time, see if you can solve through this. It will be fun if you can. In the meanwhile, Cheryl, your question was, shouldn't we use PE multiple as we give more preference? It gives you higher risky company. Okay, Cheryl. So, that will take us to a completely different topic. See, not necessarily every debt company is a risky company. Okay, if you use debt in moderation, it's actually a smart thing to do. But that's not the point here. The point here is when I'm using EV by EBITDA multiple, I'm doing an apple to apple comparison. When I have one company which is all equity, one company which is debt, when I compare a price earning ratio, that's not the correct comparison to do. That's not a correct comparison to do because the company which has debt, that company's profit anyways is going to lower because of interest, correct? So then how can I compare this profit with this profit? Ideally, the comparison should happen at the EBITDA level. That is the reason why we use EV by EBITDA multiple. All right, guys, I'm waiting for you. I'm waiting for you to give me valuation per share. The logic that we use in the PE multiple, you want to use the same logic here. I have a EV by EBITDA multiple of the industry. I have a EV by EBITDA multiple of the industry. I have the EBITDA of company A. I can figure out what should be the enterprise value of company A then. And if I know the enterprise value of company A, I know the value of their debt. I know the value of their cash. I can figure out what should be the value of equity. I can figure out the value of equity. I can divide that with number of shares and I can get the valuation per share. Okay, think through this, see if you can solve. Okay, guys, here's how you're supposed to solve this. So you would say, okay, if the average multiple is 8 and if the EBITDA level is 2,000, then the enterprise value then the enterprise value should be 2000 into 8, 16,000. Is that correct? Now, what is the formula for enterprise value? Enterprise value is calculated as the value of equity plus the value of debt. Now, we don't have preference shares here anyways, minus the cash. Now, let's do fill in the blanks. Do I know the value of enterprise? Yes. How much? 16,000. So I'm short of space. I'm kind of trying to squeeze it in here. Enterprise value is 16,000. Equity, that's what we want to calculate, right? Equity, we don't know. So equity plus, do I know debt? Yes. Debt, generally book values and market values are the same. So I'm going to take debt as it is. If you took equity as 3,000, you made a mistake because this equity is book value. This is book value. This is not market value. We're trying to figure out what would be the market value, right? So, so debt 5,000, cash 2,000. Now I have a beautiful equation ready. I can solve for the value of equity like this. So I can say the value of equity should be equal to, I have 16,000 on this side of the equation. So we have 16,000 here. Let's move 5,000 on the other side. So minus 5,000. Let's move 2,000 on the other side, plus 2,000. So the entire value of my equity is going to be 13,000. But this is the value of all the equity. What is the value per share? Value per share. So value per share should be 13,000 divided by 13,000 divided by 10. 13,000 divided by 10, 1,300 rupees per share is your valuation per share. These are the type of questions you'd probably have at CF level 1. Is this making sense, guys? Do you think you'd be able to handle questions like these? So it's just the equation. Enterprise value is equal to equity plus debt minus cash. If you can get the enterprise value, you have the debt, you have the cash, you should be able to calculate the valuation of the equity. Just give me a yes or no, please. Okay, good, 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 good. Happy to know that this is making sense. Very nice, good. Correct, Abhinav. So what we did is, Abhinav, we used EBITDA of A and we took an average EV by EBITDA multiple in the industry. So we took EBITDA of A multiplied by the average EV by EBITDA multiple, and that's how we got the valuation. Can you please tell how 16,000 came? Same stuff, Ajinkya. 2,000 is the EBITDA of company A. On an average in this industry, the enterprise value should be 8 times of EBITDA. So when I multiply, I get 16,000. Do you want to practice one more? Let's do one more quickly. Okay. So that it's kind of solid in our minds and we don't have to worry about it. Okay. So let's say, let us say we have a company X. We have a company X which has a EBITDA multiple, which has a EBITDA of 100, and it has market value of debt of 50. It has market value of preference shares also this time. Preference shares 50. It has some short term, or it has some investments of, let's say, of 120. The average EV by EBITDA multiple in the industry, the average EV by EBITDA multiple in the industry is let's say a crazy 12, massive EV by EBITDA multiple, and the number of shares issued the number of shares issued will be let's say 50. So based on this information, calculate value per share using EV by EBITDA technique. Calculate the value per share. Okay, so here's how you're going to do it. First, you're going to figure out what the enterprise value is going to be, which is going to be the EBITDA of the business multiplied with the average EV by EBITDA multiple, which is going to be 100 into 12, 1200. Then you're going to plot your formula, which is enterprise value is equal to equity plus debt plus preference shares, market value of each one of them minus the investments that you have. Now, since this is 1200, equity value is what we need to figure out. Debt value is known to us, which is 50. Preference share value is known to us, which is another 50. Is investment is known to us, which is 120. Let's work a little bit around our equation. So we get equity is equal to 1200 minus 50 minus 50 plus 120. So what are we looking at? We're looking at 1220. Now, what is the value per share? So per share, we have 1220 divided by 50, and 1220 divided by 50, how much would that be? A little more than 24.4. 24.4. So there you go. That's right. Congratulations. You're doing it perfectly well. You probably got yourself one question on the level 1 exams, maybe two. Good. Um, let's make progress. Now, more or less, relative valuation is done. Now it's time to jump on the discounted cash flow valuation. Uh, I'll suggest we should take a small break, maybe 10-15 minutes, so that you guys feel comfortable and I'm not bombarding too much of content on you. The only thing I'll have to check is, just give me a minute. I'll have to check if it's going to be a new YouTube link or the same link. Okay, give me a minute. Let me just talk to Dashrath in the office and figure out how to do this. No, 15 minutes. Okay, guys. So it's going to be the same link. So what I'm going to do is I'm going to kind of put some sort of a timer on my screen, so that you guys understand how long the break we have, and then you come back, and then we will resume with the session. Now, more or less, we're done with relative valuation. So after the break, we're going to do more on the discounted cash flow valuation, in particular, a type of model called the dividend discount model and the free cash flow model. Okay. So 15 minutes, come back, get a nice cup of coffee, and then we'll get started. Okay. I'll tell you why. I'll tell you why I'm asking this. So in the break, I was talking to my colleagues here in the office. I'm sitting in the Pune office. Sorry, I'm also making my coffee while talking to you. So my mom knows the whole universe. So we were talking about this concept called social contract. Okay, it's some sort of a psychology, a behavioral concept called the social contracting. What social contracting essentially means is, it means humans, inherently are social animals, and at times we do things, to be kind of considered or accepted as a part of the society, right? So the way that social contracting works is, uh, if you go and tell everyone that, see boss, I'm writing the CFA exam of May, rather than keeping it secret, if you go and tell everyone, if you go and tell everyone that I'm going to write CFA exams, then now what is going to happen is, you would, somewhere at the back of your mind, you would worry that, whenever results come out, these guys will ask me, or maybe when I met these people, 3 months, 4 months down the line, they will ask me, you were writing CFA exams, what happened? Right? Did you pass? Did you not pass? Why are you hiding it from me? So now what that does is, it puts an additional level of incentive or a pressure on you to perform, and it keeps you disciplined. Okay, and this social contracting works like magic. Okay, and it can work on anything. For example, if you have a habit that you feel like you want to quit. Okay, maybe you smoke, maybe you drink, maybe you don't sleep well, whatever. Go on Facebook and say that, so like, one of my colleague, right, we were discussing like the how to get fit type of issues. So what I told her is, I said, go on Facebook, or go to your friends and make them a commitment that within a month, I'm going to achieve this fitness goal. And now what happens is, it automatically puts pressure. So every time you have the craving of eating that junk food, which is in front of you, now you think of what you have promised to your friends, or what you've told your friends, and that thinking, that social pressure, that social contract is going to kind of uh, work as some sort of a stopper for you to do that, eat that pizza, or eat that burger, or whatever junk food, the soda pop that you want to have. And this works like magic. So you guys experiment, go and tell everyone that you're writing CFA. Go and tell, make sure everyone knows that you're writing the CFA exams. And what that will do now, that will put pressure on you, that now that if you don't pass, then you're in trouble, right? So that's going to force you to perform to your best. That doesn't make sense. Do you agree with you, or do you think you're more of a secret operator? Okay, guys, I'm also going to make my coffee along the way. I did not get I did not get time in the break, so I'll kind of quickly get it done now. So I do this thing called AeroPress. It's pretty good. I do it in the office itself, and it makes decent coffee. Okay, so how are you finding the equity valuation so far? Do you think it's easy, it's manageable, or do you think it's a tough topic? Do you think you'd not be able to handle it? Easy or difficult so far? And how many of you think now that you'd probably want to have a career in equity? How many of you think that this is exciting? I want to I want to have a career in equity. It's an interesting career, because this career essentially requires you. Okay, I'm going to press it now. This is kind of the most delicate part of. I'm not very good at it, but I'm learning. Yeah, but this makes a pretty nice coffee. Cheers, guys. You also Enjoy. I'm sure you have your coffees ready with you, and mine is ready too now. I was saying equity valuation or equity research as a career is very interesting, because what you really do is what you do is what you really do in this career is just learn all your life, right? All your life, what you want to do is learn more businesses, read more books. So if you're that kind of a person who likes to read, who likes to learn, and you're not the kinds who think that, okay, I'm done with CFA, I'm done with studies for the rest of my life. If you're that person, maybe this is not the career for you. But if you're someone who thinks that I would probably enjoy learning all my life, I'll probably like reading all my life, and serious reading, like probably 200, 300 pages a day type of a reading. So if you're someone who can absorb that kind of a content, on a regular basis, I'm sure you'd find this career very fulfilling. Okay. All right, Sid. With this background, now let's have fun with dividend. Uh, in fact, a broader umbrella. Let's have fun with the discounted cash flow models. Discounted cash flow models. Within discounted cash flow, we have a few variants here. So we have something called as the dividend discount model. We have something called as free cash flow to the firm model, so FCFF. And then we have something called as uh, free cash flow to equity, FCFE. So dividend discount model, free cash flow to the firm model, and free cash flow to the equity model. Now, what does it mean? What are these models about? So these are just alternate definitions of cash flow, right? How do you define a cash flow? So either you define that in the context of DDM, or in the context of free cash flow to the firm, or in the context of free cash flow to equity. Of course, I'll show you what they mean. But I'm going to start with DDM first, right? I'm going to start with DDM because that's probably like the easiest way to handle this. Now, the way DDM works is it comes the thinking comes like this. Value of a stock value of a stock is present value of all future cash flows that I expect to receive from the stock. Value of a stock is present value of all future cash flows that you expect to receive. Now, when I buy a stock, right, and now there are two types of people here. Let's say a gentleman who's like you and me, would probably buying, a very small ownership in the company, right? A small investor. So typically, these guys, they're called a minority shareholder. Okay, so these guys are minority shareholder. And then we have a investor who's really large, like the Bill Ackmans and Carl Icahn types, like the really big biggies, who don't buy a small percentage, but they buy a large chunk of company, right? A large ownership. Large ownership would be buy 25, 30, 40, 50%, whatever. They buy large company. So these guys will typically call them as they could be a majority shareholder. Now, for majority, you typically need more than 50%, but it depends depending on how the shareholding structure is. But let's call them as a majority shareholder. Okay, majority. So depending on whether you're a minority shareholder or a majority shareholder, the definition of this cash flow will change. Because if you're a small shareholder, what will you do? You'll have to accept what the company gives you. You don't have much to do, right? So when you're a minority shareholder, the cash flow definition for you is dividend. The cash flow definition for you is dividend. And uh, you're going to say, that I'm receiving these, I'm receiving these dividends. I cannot really force company to do something. I cannot force them to pay more or pay less. So I'm just going to accept whatever dividends they pay me, and I will do my valuation accordingly. But if you're a majority shareholder, you're see, I am the most important guy in this company. I am the one who is going to decide how much dividend is to be paid. So don't show me dividend. Instead, show me how much cash we have so that I will decide if dividend is to be paid or not. So how much free cash we have, right? So when you use a free cash model, then you are taking a majority perspective. If you're using a dividend model, you're taking a minority perspective. Is this something that's clear to you? Is this something that's making sense? The majority and the minority perspective. So dividend discount model is to be used for a minority shareholder perspective, someone who just accepts the dividend that the company pays but cannot really negotiate too much, whereas the majority shareholder is the one who decides how much dividend will be paid. So he doesn't care about amount of dividend, he cares about how much free cash is available inside the business. So now starting point for us is dividend. Okay, and we'll keep it very, very simple. I'm going to do a series of about 13 examples with you. Okay, 13 to 14 examples. And these examples are so comprehensive that you would not be required to do anything else uh, for these different discount models. You just practice, these questions or revise what we've done, and you'd be able to solve any question on the exam with reasonable confidence. So let me just create some nice space on my screen. Let's add some nice colors. It's always good to have colors. Our brain likes colors. It's the pictorial memory that works magic. Uh, Very soon on YouTube, I'm going to do an experiment. Uh, you'd see that maybe next week or a week after that, we'll be posting a video. I've been thinking about that for a while, where I'm trying to kind of experiment and bring in a little bit of real life with studies, mix the two and throw in some videos and see how people react to it. We'll see how it works. Anyway, so example number one, straightforward example. There is a share that you buy, and this is a timeline, a time 0 and a time 1. Time 0 and time 1. Now next year, you expect to receive a dividend of 20 rupees. Okay. Yeah, it does look like a flag, right? So next year, you expect to receive a dividend of 20 rupees. And you somehow know, right? How do you know that? That's magic. How do you uh, know that? It's somehow through magic. You somehow figured out that next year stock price is going to be let us say 2000 rupees. All right, now this 2000, the stock price at the end of year 1, this is called terminal value. Okay, the future stock price, you somehow figure that out. We call that as terminal value. Now the cost of equity, and that is going to be an important number in this reading. Now the cost of equity means how much do you expect to earn. How much do you expect to earn? So let's say you expect to earn probably 25% per annum. So what you do now, you apply a simple dividend discount model. Value of a stock is present value of all future cash flow. I'm going to buy this stock now. I'm going to buy this stock now. Next year I will sell it. I will get 20 plus I will get 2000. I want to discount them at 25%. Let's fire up your TVM rows. We will do this together. I want you to be super alert today. So let's fire your TVM rows, please. And second, clear TVM. 20 is payment, 2000 is future value, uh, 1 is N, and 25 is IY, compute present value. Just discount these numbers backward, and your answer here will be 161616. Let me write it somewhere else. Your answer here will be, answer here is 1616. Is this the common answer? Are you all also getting the same answer here? Guys, yes, no, are you getting 1616? If you are, great. So that's your first question on dividend discount model. Straightforward, easy. You should be able to handle this without any difficulty. Now, question number 2, let's kind of scale up the level of difficulty a bit now. So now you're buying a stock at time 0, but now you probably plan to hold it for 3 years. So time 0, time 1, time 2, and time 3. At time 0, you received a dividend of 10. At time 1, you expect to receive a dividend of 15. At time 2, you expect to receive 22. How do you get these numbers? Typically through financial modeling, right? Understanding business, what might be happening to the business, and then trying to forecast them. At time 3, you would probably get 30. You would sell the stock at time 3 and you would be able to sell it for, let's say, 600. Cost of equity, just for simplicity, let's keep this as 25%. So now what you want to do is you want to discount all these cash flows backward. Now, one thing that you're going to keep in mind is that we always work with future cash flows, not the ones that I've already received. So this will never be a part of your calculation. It is just used so that you can figure out the future dividend. But the time 1 dividend, you're not going to use it for discounting purposes. All right. So how can we do this math? We can use the cash flow function of the calculator. So let's use the cash flow function together. I'm going to put this on charge. Hit the cash flow button, says second clear work. Come on to cash flow 1 and make this cash flow 1 as 15. Come on to cash flow 2, make it 22. Come on to cash flow 3, make it 630. Then press the NPV button. Once you've inserted all the cash flow, press the NPV button. It will show you I, set 25, enter. I is the discount rate, and press the NPV button, downward arrow. It will show you NPV, press compute, and you would get your answer. And come on, help me with it. What number are you getting here? So you would get your answer, and that would be 348, or I'm going to round it off to 49. So that's your answer for the second question here. Okay, I hope you're finding this easy. I hope you're able to solve this by yourself without any difficulty. Now let us jump on to question. Let me increase a little bit of difficulty. Question number 3. Question number 3. Now, the dividend at time 0 paid by a company is 10, and you think that this number would be a constant perpetuity. A constant perpetuity. What do you mean by that? It means the amount of 10 you'd receive forever. So which basically means D0 will be same as D1, will be same as D2, will be same as D3, will be same as up to infinity. Correct? The amount of money is going to be same in every window. Now the discount rate is 25%. So now we come down to valuation of a classic perpetuity stream of cash flow. So we will say valuation at time 0 would be equal to what is my cash flow here, or what is my dividend here, divided by what is my cost of equity. So this is called as a perpetuity valuation formula. And can you guys please do this and give me an answer here? Can you help me out with the calculation? It would be 10 divided by 25 percentage. Tell me how much is this number? 10 divided by 25 percentage, how much is this number? Correct. The number is going to be 4040. So your next answer is 4040. Okay. Now, if you've understood all the three, give me a yes. If you would like me to repeat any of the three calculation, type down the number of the which number of calculation you want me to repeat. You want me to repeat 1, 2, or 3, or just give me a yes if you want me to. If you want me to move forward. Okay. So the second one people need help with. So I'm going to help you out with the. I'm going to help you out with the second calculation. If you would probably need help with the second calculation if you're not good with using the calculator. Okay, so it's just learning to use the calculator properly. So see how the calculator will be used. Please press the cash flow button of your calculator. Okay, let me see if I can show it on my screen. Wait a minute. Let me make an attempt to bring it on my screen. Okay, just a minute. There must be an easy way to do it. Come on. Just a minute, guys. I think if I can bring it on my screen, it will be very easy for you. There is a screen mirroring option. Let me just see if it works well. All right. So here's how this is going to work. Press now. You guys don't do it. Just see how I'm doing it. First thing that I'm going to do is I'm going to press this cash flow button. So I'm going to press this cash flow button. Then I'm going to press second here where my mouse is and clear work. So second and clear work. Then once I have pressed second and clear work, then I have to insert the number. So I'm going to press this downward arrow. Please don't do it. Don't do it. Just watch. I'm going to press this downward arrow. Now I have to start inserting numbers. My first dividend is 15. So I'm going to say 15 and then I'm going to press the enter button. So enter. Then I'm going to press downward arrow again. Downward arrow again. It will bring me cash flow 2. Now here I will say 22, enter. Okay. Downward again. Now my cash flow 3 has to be dividend plus the market price together, right? Market price is 600 and dividend is 30. So that's 630. So 630, enter. Then I'm going to press the NPV button. So press the NPV button here. It shows I. I is the discount rate, the interest rate. 25, enter. Then press the downward arrow. It shows NPV. Then when I have NPV on the screen, I have to press this CPT or compute button of the calculator. And when I do that, it gives me valuation of 348. Okay, now you try. Now you see if this works for you. There's just a learning curve. Do it a few times. You're going to be all right. Okay, and if you're able to do it, then just give me a happy smiley on the chat box. If you're able to do it, even the ones who already did it, if this is working for you, give me a happy smiley. If it is not working, then we will have to figure out some way to make sure you learn it. Good. Happy to know you're able to do it. Some people are asking, why did you not increase the dividend? That is because, uh, Jash, it is a constant perpetuity. A constant means I will receive. A constant means I will receive 10 forever. I would have that 10 forever. I would receive that 10, you know, every year. So because that 10 is not going to change, don't need to increase it. Okay. But let's go to a few more questions. Let's add some more pretty colors here. Okay. So next, why are there so many robots in the in the chat? Okay. All right, some smart people here. All right, guys. Anyways, so uh, now example number four. Example number four. Let's try and have some fun with it. Let's try and have some fun with it. Example number four. I'm going to increase the level of difficulty a bit here. Okay. So now D0, D0 is 20, but now it is a growing perpetuity. Now, what do you mean by a growing perpetuity? What you mean by a growing perpetuity is what you mean by a growing perpetuity is every year, the dividend that you receive will increase. So today maybe it is 20, but next year it will be higher. So let's say a perpetual growth rate of 10 percentage. All right. So what does it mean? It means today I got 20, tomorrow I will probably get 22, then maybe 24 point something, and then that number will keep on growing. So a growing perpetuity. Cost of equity is 25 percentage. Now, this is our first example where we're encountering that G, and that G is called the constant growth rate. Okay. Now for that G, your syllabus stupidly gives you this formula, which I really hate because this is not how real world works, but I'll explain that formula a little later to you. That formula is return on equity into retention ratio. But if you don't understand that, it's okay. It's okay. We're going to revisit this later on, not now. For the time being, it's a growing perpetuity of 10 percentage, cost of equity of 25. Now what we want to do, we want to value the company at time zero. Okay. And your valuation at time zero is going to be like this. V0 is equal to, now I'm showing you a growing perpetuity formula, also called the Gordon growth model. Type of formula is also called GGM, the Gordon growth model. And how does this formula work? If you want valuation at time zero, you have to take dividend of year one in the numerator divided by what is the cost of equity minus the growth rate. Now, the dividend of year one, how would I calculate? So I will take dividend of year zero, dividend of year zero. I will multiply that with 1 plus the growth rate, 10 percentage. So 1 plus the growth rate divided by KE minus G, which is equal to, what is my dividend of year zero? Dividend of year zero is 20, 20, multiplied with 1 plus. What is my growth rate? 10 percentage. So 20 growing at the rate of 10% becomes 22, divided by what is my cost of equity? 25%. What is my growth rate? 10%. That's how easy the formula is. D1 divided by K minus G. It gives you what? It gives you V0. So that is equal to 22 divided by 15%. And 22 divided by 15%, my final answer, and you guys please help me with it. Please help me get the number. 22 divided by 15%. 22 divided by 15%. Come on, help me with the number here. 22 divided by 15%. This is 146.66. 146.66. That is how you do a classic Gordon growth model. And it's kind of a beautiful model because this captures the present value of all the growing dividend in future automatically. Okay. What is really, really important here in Gordon growth model is to appreciate that when I want a valuation of time zero, in the numerator of the formula, I take dividend of year one. These are the two subscripts that you want to be really careful with. If my numerator is of year one, my valuation is going to be of year zero. If my numerator is of year six, my valuation would be of year five. If my numerator is of year 20, my valuation is of year 19. Okay, that is how these valuations work. Now, is this making sense? And if it is making sense to you, then let me now integrate everything that we've learned, the example number 4 and example number 2, and let me throw in a question at you. Now, let us say we have a situation where D0 is 10, D1 is 11, D2 is 18, D3 is 20, and thereafter, the dividend will grow. The dividend will grow at a constant rate, at a constant rate of, let's say, 8% per annum. Okay, thereafter dividend will grow at a constant rate of 8% per annum. Cost of equity is 25%. From this information, try and calculate the value of the stock. Someone on the Siddharth is asked, what if my growth is higher than cost of equity? Siddharth, then this model cannot be used. That's kind of a limitation of the Gordon growth model. Should be lower than cost of equity, which is kind of also a logical thing to happen in practice. But if the growth is higher than cost of equity, GGM doesn't work. All right, guys, so get on with it. Let's see if you can get the answer here. Okay, I'm going to solve this now. Let's see if you're able to do it together. If you're able to do this before me, keep on posting your answers on the chat box. All right. But I'm also doing it parallelly. You guys can also do it. Then we can compare if your and my number matches. If you're able to do this, you're kind of reaching to the CFA level 1 level. You should be able to get through the exam questions easily on this section then. So here is how that valuation is going to work. So we have this time 0 here, time 1, time 2, time 3, and maybe I'll need time 4 as well. Okay. Time 0 dividend is 10, time 1 is 11, time 2 is 18. Here we have 20. I'm going to need a little more space, so get rid of the green part here. Okay. Now, do I really need D4? Do I need to calculate D4? Yes, because I'm going to calculate value at year 3. Why will I calculate value at year 3? Because the perpetuity, the perpetual growth starts from year 4. All right, guys. And see, this is where there's a slight difference in how I solve this vis-a-vis how the CFA curriculum treats it, or how some of the private prep providers treat it. It's a different in approaching the question, but the answer is the same. Okay, so I want you to listen to this very carefully. The technique that I use, I find that relatively easier. If my first perpetual, okay, everyone, I hope you're listening to me. If my sorry for my voice. If my first perpetual dividend is coming in at year 4, okay, if my first perpetual dividend is coming in at year 4 here, then I'm going to do a valuation of year 3. Okay, so valuation of year 3 is going to be equal to, valuation of year 3 is going to be equal to dividend of year 4 divided by K minus G. Like how I did it: dividend of year 1, valuation of year 0, dividend of year 4, valuation of year 3. Okay, so hopefully this is making sense. Now, dividend of year 4, how will I get that? So dividend of year 4 will come like this. It is 20, which is dividend of year 3, multiplied with 1 plus growth rate of 8 percentage, so 1.08, divided by 25 minus 8 percentage, so 25 percentage minus 8 percentage. Okay, so can you please help me do the math and tell me what number is that? So that number would have been 20 into 1.08 divided by 0.17, that is 17 percentage. Come on, help me with the number, please. It would be, tell me how much. It would be 127.05, right? 127.05. Let me repeat that calculation one more time for you. 20 into 1.08. So when I do that, numerator becomes 21.6. Numerator is 21.6. Okay. Divided by 17 percentage equal to 17 percentage equal to, and that gives me K minus G. That gives me the value. Now, all right, very interesting. Now, when I want to discount these numbers, which numbers am I going to discount? Do you think I should discount this 10? Like, do you think this 10 should be a part of my valuation? Yes or no? Do you think this 10 should be a part of my valuation? No. Why? Because it is not a future cash flow. It is not a future cash flow. So no, not this 10. Do you think 21.61 should be discounted backwards? How about 21.6? Yes or no? Should I discount that 21.6 backwards? Yes or no? No again. And why is that? Because this 21.6 again is the cash flow after the terminal value. My terminal value is in year 3. My terminal value is in year 3. So I'm not going to take any cash flow after the terminal value. I don't need to. So these are really the cash flows that I need. A cash flow of 11, a cash flow of 18, a cash flow of 20 in year 3, and a cash flow of 127.05. Okay, I will not take the cash flow of 10. I will not take the cash flow of 21.6. Then the question is, why did I calculate 21.6? So that I could get 127. Correct? The reason why I calculated 21.6 so that I will get 127. But once I get my terminal value here, then I don't take cash flows after the terminal value. Now, how did I get 21.6? This numerator is 21.6, 20 into 1.08. Okay. Now, these are the cash flows I have to discount in my cash flow function, and rest of the stuff is easy. I'm sure you guys know how to do it. Press the cash flow button. Say second clear work, come on to cash flow 1, 11, enter. Cash flow 2, 18, enter. Cash flow 3, 20 plus 127.05, enter. Press the NPV button, keep the discount rate as 25, and compute the value of the stock, and help me out, please. What number have you got? What is the valuation of the stock you have? What's your number? Your number is 95.6. So that's how you do a multi-stage dividend discount model. Easy. Is there any part you want me to repeat? If you've understood 4 and 5, give me a smiley. If you want me to repeat any of it, just type down the number. Just type down the number. If you want me to repeat 5, just type it down. If there are enough people struggling with that, I will repeat it. Okay. All right. Fair enough. Just wait now. I think there are some people who are struggling with the fifth calculation. So I'm going to repeat it one more time. It's very simple. See, I had D0, so I wrote that. D1 available, D2 available, D3 available. Okay. First thing that I did is I calculated D4. D4 is my first dividend calculated using the perpetual growth rate, right? So how did I calculate D4? 20 into 1.08. I just grew it by 8%. Then I used, if my D4 is my numerator, my valuation comes out to be V3, and then that became 21.08, 21.6 divided by 17%. I got 127. Now the only thing that's left is inserting this into your cash flow function. So I'll show you how to do it on the cash flow. Let me get my calculator on the screen. Okay. So let's do it on the cash flow function. What you do is press number 1. Step number 1, you have to press the cash flow button. So I'm pressing the cash flow. Then you have to press second button and clear work button to delete if there was anything saved, delete if there was anything saved previously. So second and clear work. Now press downward arrow, this button here, the downward arrow button. So downward arrow, it shows cash flow 1. Then say 11 and hit the enter button. This is the enter one. Enter. Downward arrow twice. It shows cash flow 2. 18. Enter. Downward arrow twice. It shows cash flow 3. That would be 127.05 plus 20. Enter. So that gives me 147.05. Okay, 147.05. Now press the NPV button. This is the NPV button here. This is the NPV button. Okay, so press the NPV button here. So I'm pressing the NPV button. Then it shows I have to insert the discount rate. So say 25, enter. Then press downward arrow. So when you press downward arrow, it shows NPV 0. And finally press this CPT button, the compute button, the first button of the calculator. So press compute. That's it. Very easy. No cal. No complications whatsoever. Got it now? Any other questions you have? Any other doubts you have? For V3, can the formula be D4 divided by K? No. For V3, it has to be, see, D4 divided by K works if it's a constant perpetuity. Constant means it will never grow. It will be the same number when growth rate is zero. But when we have a growth rate, when you want to calculate V3, it has to be D4 divided by K minus G. If the growth rate is higher than cost of equity, GMM model does not be used. Can you explain the reason? I did not understand. Ajay, is very simple. Ajay, it's very simple. He's asking me, can you use GGM if growth rate is higher than cost of equity? The answer is you cannot use GGM. GGM cannot be used, cannot be used. Okay, and why is that? Is there a theoretical background to it? Is there a rationale to it? So one is clearly the mathematical reason. What is the mathematical reason? Uh, Denominator is K minus G, right? And you do not want this to be negative because then your stock price will be negative, right? So mathematically this will not work because you do not have negative stock prices, at least so far. We've seen negative, we've seen negative oil prices, but we've not seen negative stock prices yet. But why why uh, why not intuitively? Cost of equity means what investor wants to earn or deserves to earn. Okay, what investor deserves to earn. And uh, and growth means how much company is expected to grow, at what rate company will grow. Now clearly if a company is growing at 25%, if a company is growing at 25%, you will not you would be a stupid investor if you come and say I want to earn 15% on this, right? It does not work in the finance that way. So so the way it works is, if a company is growing at 25, as an investor you would say, okay, you know what, such a great company, I want to earn 30% out of it, right? I want to earn, I want to earn more on it. Wait a minute, something happened here. My battery just the battery kind of died off, the tablet one. Okay, so you would be stupid to say that I want to earn 15%. Of course, you would say, you know what, I want to earn 40% here. So from that perspective, KE should be greater than G. KE should be greater than G. GGM works. KE less than G. GGM does not work. Remember that. When the growth rate is higher than the cost of equity, GGM will not work. Uh, what is the name of the app? Ritik, instrument app. You get it on the App Store. It'll cost you something. I don't remember. I bought it like long time back, 4 or 5 years ago. But about $10-15, like 1,000-1,500 rupees or something like that. But it's worth it. If you have an iPhone or if you have any of the Apple device, I'll strongly encourage or you to consider buying an app, because the good thing with this is you carry your mobile phones with you everywhere. Okay, should we do some more practice? Are you guys absorbing? Are you enjoying it? Is it going well, or is it becoming too much in one day? Should we do some more? let's at least finish the Gordon growth model. I know you, this is tiring, and I know we've learned a lot today, but let's finish the Gordon growth model first. Okay, that'll be fun. So let's jump on to example number 6. Now, example number 6 is, I'm going to make this very, very comprehensive. Example number 6 is going to be a lot of fun. And I'll also make it a little exam like, you'd be required to do a little bit of more formulas. Okay, Gorish has you bombarding the chat box with your issue, Gorish. You are not pressing the enter button. That's why you're not able to go to CF3. Just press the this plus this enter. That's it. This plus this equal to enter. It works. And just work on your level 0, Gorish. It looks like it's your first day. Do level 0 sincerely. Do all the videos. You would be comfortable. All right. So number 6. D0 is 50. Now, year 1 to 3, you expect to grow at 25 percentage. Year 4 to 5, you expect to grow at 15 percentage. And 6 onwards, 6 onwards, you would grow forever at 8 percentage. Cost of equity is 25 percentage. This is a classic, classic exam like question. This is called a multi-stage model, a multi-stage dividend discount model. Okay. And how many stages we have here? We have 3 stages here. Which 3 stage? Supernormal growth, stage 1, supernormal growth, stage 2, and then a constant growth, stage 3. Now, out of these, which one is your G, by the way? Is your G that we use in the formula, is it 25 or is it 15 or is it 8? Is your G 25 or is it 15 or is it 8? What is the true G here? Your G here is 8 percentage. Okay, so please keep that in your mind. G is always the perpetual growth rate. Okay, these are not your G's. I mean, these are growth rate, but they are not perpetual growth rate. So when you apply that Gordon growth formula, you have to use this. Now, what they might do on the exam is, just to mess with you, they will probably not give you that G. They will say ROE stands for return on equity. So they will say ROE is 40 percentage, and they will say retention ratio. Retention ratio means when you make profit, how much of that profit do you keep in the business? Okay. So they will give you retention ratio of, let's say, 20 percentage. So maybe on the exam, they will not give you that G directly, but they will give you ROE and RR, return on equity, retention ratio. But when you multiply these two, you get that 8 percentage. Okay. Now in this question, I'm giving you 8 directly. In this question, I'm giving you 8 directly, but just keep that at the back of the mind. If the G is not given, you need to search for return on equity and retention ratio number, and then multiply the two to get the G. All right. Now, this question is kind of similar to question number 5, except that in question number 5, I gave you the dividend amounts, right? Here, you'll have to calculate the dividend amounts. Then you'll have to calculate the terminal value, and then you'll have to discount all the numbers backwards to get your final answer. Okay, do you think you'll be able to do it? Do you want to try this yourself? Give it a try. I'm waiting for you. I'll give you 30 seconds to play around. Otherwise, then I will 30 seconds or maybe 60 seconds. Otherwise, then I will solve it for you. All right, get started. Get started, please. Okay, so here's how this will be solved. Make a beautiful timeline. The moment you learn to visualize questions like this, it becomes easier. So it's important that you draw a timeline. Time 0, time 1, time 2, time 3, time 4, time 5. My first perpetual dividend comes in at time 6. Time 0, 50. Let's start doing it on the calculator. Uh, 50, 50, multiplied with 1.1.25. When I multiply with 1.25, it's like growing at 25%. So that's 62.5. Multiplied with 1.25, that is 78.125. 3 years, right? 3 years. So multiply with 1.25 one more time. So multiply with 1.25, and that gives me 97.66, rounding it off. Multiplied with, now I have to change my growth rate. So multiplied with 1.15. Multiplied with 1.15. So that's 112.30. Multiplied with 1.15, that becomes 129.15, right? So I'm just kind of trying to figure out what the dividend is going to be. Now, finally, the D6 at perpetual rate, the first perpetual growth dividend into 1.08, into 1.08, and here I will get 139.48. Now, using the dividend of year 6, I can get the valuation of year 5. So valuation of year 5 is equal to dividend of year 6. How did I decide that I want to put D6 in the numerator? Because it was the first perpetual dividend. So D6 divided by KE minus G. D6 divided by KE minus G. So that is going to be 139.48 divided by 25 percentage minus 8 percentage. So 139.48 divided by 0.17, I'm getting a valuation of about 820. 820.5, rounding it off. Now, how many cash flows I'm looking at? Okay, so let me just kind of put some boxes around them. Okay. Now, do you think I should take 50 as a discounted cash flow, or do you think I should consider 50 while doing the math? Oh, thank you, Mithun. That's very nice. Thank you very much. Uh, do you think I should take 50 while doing this? No, right? I should not take 50. Uh, do you think do you think I should take 139 while doing the math? No, because I'm taking the terminal value of year 5 anyways. So no, not here. So these are the cash flows that I want to work with. I want to work with 62.5. I want to work with 78.125, 97.666, 112.30, 129.15, and 820.5, right? So press the cash flow button, then say second clear work. 62.5, sorry, pressing the cash flow button, second clear work, coming on to cash flow 1, 62.5, enter. Cash flow 2, 78.125, enter. Downward arrow twice. Cash flow 3, 97.66, enter. Cash flow 4, 112.30, enter. Cash flow 4, I need to add up the two numbers, 129.15 plus 820.5, enter. So I'm getting a total of 949 there in the cash flow 5. Then I'm going to hit the NPV button. What should be my I in NPV? My I in NPV should be 25 percentage, right? So 25, not percentage, because calculator understands it's a percentage. So 25, press downward arrow, it shows you NPV, press compute, and you get your answer. And if you get this answer right, it's going to make you very, very, very happy with yourself. Your answer here is, come on, tell me how much. Your answer here is 507.18. 507.18. That is your final answer. Now, those of you who got this right, you should be really proud of yourself because you've learned something truly tangible today. And those of you who couldn't do it, it's perfectly all right. Uh, we don't automatically, we did not knew it before we did not know it before we started. There's a learning curve. We are in the process. We're working hard. It's not that we are sitting on our sofa and watching television. We're trying to learn something, and that is the positive thing. That is kind of differentiating you from rest of the world and rest of the CFA candidates. So you are doing good. If you made a mistake, figure out where you did that and fix it. Okay, my throat is totally blasted now. High pitch consecutive sessions last night and today. Dimple, if you need to write CFA exams, you'd probably want to get the calculator. If you are just doing this to learn equity, you can do this on an Excel file as well. All right, guys, now it's about 12:50 India time. So we've kind of exceeded the time we'd allocated. What has happened is I've still not been able to cover everything that I wanted. Okay, because we're spending more time for practicing questions. Uh, what I'm left with is I'm left with small theory pieces, not very significant, but small theory pieces. So what we will do is today's session, we will kind of call it a day now, because we don't want to kind of go overboard on one single day and try to load up everything. Next week, when we start the session, in the first 30 minutes to an hour, I will take you through all the missing theory learning outcomes. That session we will do on YouTube itself, so that we not only do the numericals, but you're also comfortable with theory. There is one ratio that I haven't covered with you. In fact, two ratios that I need to cover. So we'll cover those ratios as well. And then we will go to the next reading, which is going to be market efficiency. All right. So all those of you who are FinTree candidates, you guys will have to write a weekly test. Okay, so we're going to build a weekly test for you. That weekly test would be on 19th of December. And the test topic is going to be just equity valuation and nothing else. Okay, just one reading, but it's a large reading. So this week you go through the videos, you make sure you're comfortable with the concept. You go through the reading, you're comfortable with the concept. And then next Saturday, when we start the session, first 1.5 hours, we will meet on YouTube. We will finish, all the remaining small pieces. And then we will go to market efficiency and we'll try to wrap it up. Okay, so that's it from my side. I hope you enjoyed the session today. If you can, try and kind of like the video or comment, or do whatever, whatever that probably needs to be done to kind of make the video a little more popular, since it's anyways on YouTube. Even if you just like, I think that helps a lot. Uh, but then it's purely up to you. But thank you very much. I appreciate your valuable time. There are few questions left on DDM, Abhinav, but we'll do that in the next class. There are one or two style of questions that I'll do it in the next class. Okay. So thank you very much. Appreciate your valuable time. You have been very, very patient. We had few technological troubles today, but you guys kind of stuck through it. So appreciate the efforts, and I'll see you next week now. Bye.